great friend for 40 years. As Helene mentioned, Ken has somehow taken his chess skill of being able to see several moves ahead and apply it to economics with extraordinary success. For the first 20 years of his career, I tried constantly to get my university, Stanford, to try to hire Ken. But somehow the combination of his skill and talent and my political ability kept on leaving me just a bit short, even when I had Ben Bernanke helping me. Now, what you may not know is that Ken's also a fantastic person and completely trustworthy. I was going to say that his word is like money in the bank, but given what's been happening in the CDS market the last couple days, I thought maybe some people might misinterpret that. So, one of the things I learned from my thesis advisor, Stan Fisher, is the value of having brilliant co-authors. Ken obviously is one of them. These two guys, Jacob Goldfield and Paul Klemper, are also incredibly great guys. Okay, so I'm going to lay out a bit of a proposal to use a market-based regulatory capital system. The regulatory systems that we've had in recent years have failed miserably. I think similar systems are inevitably going to fail in the future. On the other hand, if you have a market-based system, you have certain advantages. They tend to adopt fast. People tend to learn positively from them. While nothing is going to be perfect, what will happen is that in a market-based system, people will tend to respond to the incentives to improve the economics over time rather than improve the gaming. And market systems are also simple to implement and enforce. So by market-based, I don't only mean looking at prices, I mean looking at some other things too that are market information. So for example, in the case of figuring out capital requirements, you can look at haircuts, which combine information about things like price, liquidity, risk, issue of firm solvency, and you get a lot of summary information that ought to be very useful in determining a capital market requirement. It might even give you a capital market requirement. For OTC derivatives, one thing we know, they might be complicated. We might not know whose position is worth what, but the one thing we do know is that the sum of the two positions is worth zero. And that's actually an incredibly useful piece of market information, which should be used. Here's some examples of how regulatory capital has not worked so well in the past. These are the 5 biggest U.S. banks from 06 through 08. You can see what their Tier 1 capital ratios were quarter for quarter. 4% is adequately capitalized. 6% is considered well capitalized. The one at the very top there that ends 08 at 12%, the best capitalized bank, that's Citibank. One of the lines, the purple one, Wachovia Bank, you'll see it doesn't go through the last quarter. That's because the FDIC had to come in and step in. So you have these great records in terms of regulatory capital, obviously not so good in terms of what the true economics was. How do I get this to go forward? Some more examples of the regulatory capital problem. This is from a speech by Andrew Haldane of the American Economic Association. Yes, speech by Andrew Haldane of the American Economic Association. The graph on the one chart 5 shows Tier 1 ratios for banks that ended up in crisis in red, banks that did not end up in crisis in blue. You could see both numbers are solid as a rock over time. At the very end of the period, the banks that ended up in crisis inched ahead and had stronger regulatory capital. On the other hand, on a market value basis, things were very, very different. A lot of discretion in regulatory capital. If you looked at the U.S. system, U.S. commercial bank equity to asset ratios, the 70 years 1941 to 2010. What were the 7 years, the top 10%? Those were the 7 years, 2004, 2005, et cetera, up to 2010. 2010, we were the best capitalized in 70 years based on regulatory capital measures. And furthermore, there's tremendous variation in the way assets get marked by different people. So if you look at this chart below, which was from a Goldman Sachs research report for 2008, if you look at, for example, Alt-A, LEH, Lehman Brothers was valuing their Alt-A securities at 39 cents on the dollar. Well, we know what sort of happened to Lehman Brothers, but look at Citibank at the same time. They were valuing their Alt-A at 80 cents on the dollar. So, those securities were not identical. I could give you examples of people valuing identical securities substantially differently, but the basic point is here, there's a lot of discretion in how some things got marked, and Lehman, where we know what happened to them, were far from the worst or the least conservative in marking assets. Okay, in fact, here's Lehman, which makes a couple of important points. So Lehman had a press conference a couple of days before they went bust. They said that as of August 31st, 2008, they had $22.3 billion in Tier 1 capital against risk-based assets of $199 billion. So they had 11.2% Tier 1 ratio. And as a fair value firm, as I mentioned, they were probably in a little more realistic accounting than some others. Now, what happened then? Well, we've got the Lehman bankruptcy. It now looks like the unsecured creditors are going to receive $65 billion against allowed claims of $322 billion. So that means they're going to be unpaid allowed claims of $257 billion. So you can ask yourself, what kind of Tier 1 ratio would we have needed to cover that? If we had $22 billion and we needed another $257 billion, it would have been maybe pretty high ratio. Now, some of that speaks to how bad the regulatory capital system was. Some of it speaks to how bad the resolution mechanisms are. Now, in terms of some market signals, we had some information that you all know about. These are graphs of LIBOR OIS and Treasury Eurodollar spreads, where we can see that something was going on as the crisis in 2008 developed. As Stan said, a lot of people had a strong bias towards interpreting it all as a liquidity problem rather than a solvency problem, which Ken and I noticed in the 1980s tends to be the way everybody always interprets everything at the beginning. And, sometimes it's right. There's a problem looking at prices now that some prices are distorted by the possibility of a bailout. So what does it mean when you see a Fannie Mae CDS now? Here are some bank CDS. These are for Citibank, Deutsche Bank, Barclays, and BNP, the four largest banks in their respective countries. It might look from that picture like Deutsche Bank, which is up there, is riskier than BNP. Since Deutsche Bank is sponsoring this, I should just emphasize that that's not the case. Bloomberg had to use a different scale for BNP than it used for Deutsche Bank. So Deutsche Bank's actually the safest of the four, and BNP is the worst. But you can see from the graphs that there's, information here in the market about their problems developing over time. Okay. One of the big problems we've had, and we always have in these systems, is regulatory forbearance. Banks have a lot of flexibility. They've been able to move assets in and out of fair value accounts. They've been able to avoid marking to market through switching assets from level 1 to level 2, from level 2 to level 3. And once they're in level 3, they say there's no market, and so they just have to mark to model. There's an excellent paper by Lutz and Lutz about that. And the regulators face a lot of political pressure to go along. So let me give you a couple of specific examples of that. So this is the Federal Home Loan Bank of Atlanta. The bank, as of the end of the third quarter in 2008, reports it holds $16 billion in assets with a fair value that's $2.7 billion below that.